Hey, what's up, guys? This session, we're going to review Chapter 6 and Chapter 9. Chapter 6 is about capital allocation to risky assets. So there are two key things we need to keep in mind. The first is that the risk, we have two types of risk. One, the first is systematic risk, which is reviewed by beta. And the other is non-systematic risk, which is the variance or standard deviation of a single stock. So sometimes we also refer non-systematic risk to diversifiable risk, because the systematic risk is non-diversifiable. Question 1. Which of the following choices best completes the following statement? An investor with a high degree of risk aversion compared to one with a lower degree will prefer investment portfolios. So when we talk about risk aversion, we're talking about the capital letter A in the risky portfolio allocation. So it has nothing to do with higher risk premium, because if you have a higher degree of risk aversion, the risk aversion is embedded into the utility function. And what's more, if you have a higher degree of risk aversion, it means you are more risk averse to this stock or this bond or this portfolio. So you will prefer investment portfolio with a lower risk premium, because for riskier assets, you will have a higher risk premium or a higher excess required rate of return. And B, they will not prefer investment portfolios that are riskier because they are more risk averse. C with lower Sharpe ratios, D with higher Sharpe ratios. So Sharpe ratio is not a risk factor. Sharpe ratio is an adjusted rate of return factor. So the correct answer will be E, none of above is true. Number 3. What do you think would happen to the expected return on stocks if investors perceived higher volatility in the equity market? Relate your answer to equation 6.7. So equation 6.7 is like this. If investors perceive higher volatility in the equity market, then the risky proportion will drop. The Y will drop. So investors will invest less in the risky assets. So the expected return on stocks must rise because less investors want to invest in the stock. So the stock must provide much more compensation for the risk. Number 10, calculate the expected return and variance of portfolios invested in T-bills and the S&P 500 index with weights as follows. So in this problem, we assume that the Treasury bill return is 5%, and the S&P 500 standard deviation has been about 20%, and the risk premium is 8%. So we plug these numbers into the formula. For this portfolio, we have the expected return, which is the weight of investment on the Treasury bill times the expected return of the Treasury bill, plus the weight put into the index fund and the expected return of the S&P 500 index. As for the standard deviation of this portfolio, just note that Treasury bill has no standard deviation because it's risk-free. So the portfolio standard deviation is basically the standard deviation of the Treasury bill. Standard deviation of the S&P 500 index times the weight put into the index. So this is basically 1 times 20%, and this is 0.8 times 20%. And it will give us the correct number. CFA problems. Number 8. You manage an equity fund with an expected risk premium of 10% and an expected standard deviation of 14%. The rate on Treasury bills is 6%. Your client chooses to invest $60,000 of her portfolio in your equity fund and $40,000 in a T-bill money market fund. What is the expected return and standard deviation of return on your client's portfolio? So expected return for the equity fund is equal to the Treasury bill rate plus the risk premium. So the risk premium is 10% and the Treasury bill return is 6%. So the expected return of this fund is 16%. And if you invest $60,000 of your portfolio in this fund and $40,000 in T-bill, so it's 60% of your total fund invest in this equity fund and 40% of your total fund invest in T-bill. So the expected return of this whole portfolio, the return to your total fund, is 60% times the expected return on this fund plus 40% times 6% on the T-bill. If we transfer it into the dollar amount, it will be $12,000. And the standard deviation, the same as in the previous questions, T-bill has no standard deviation. Only this fund has standard deviation. And what's the standard deviation of this fund? it's 14%. So this is the percentage invested on this fund, and 14% is the standard deviation. So the total standard deviation of this portfolio, is 60% times 14%. Chapter 9, number 2. The market price of the security is $50. Its expected rate of return is 14%. The risk-free rate is 6%, and the market risk premium is 8.5%. What will be the market price of the security if its correlation coefficient with the market portfolio doubles and all other variables remain unchanged? Assume that the stock is expected to pay a constant dividend in perpetuity. So what does the last sentence mean? It means that the fundamental of the firm is unchanged. What has changed? The correlation coefficient with the market portfolio doubles. So it means that the beta has doubled. Therefore, the risk premium will also double. The current risk premium is 14%. Expected rate of return, 14%, minus 6% treasury bill rate. So the current risk premium is 8%. The new risk premium would be twice of 8%, so it's 16%. And now the expected rate of return should be 16% plus the risk-free rate, the treasury bill rate. So now the expected return should be 22%. And we need to use 22% as our new discount rate. So remember, the discount rate we use is the required or expected rate of return. If the stock pays a constant perpetual dividend, then we know from the original data that if the price is $50, we can calculate the constant dividend. And the discount rate is the expected return, 14%. So the dividend as perpetuity is $7 per year. And if we use the same formula, the constant growth model or the constant dividend model, then it's $7 over 22% discount rate. So the new stock price should be $31.82. And the current market price is 50. Now it should be 31. So the increase in stock risk, which is beta, has doubled, has lowered its value by 36%. It's 50 minus 31.82 over 50. Number 3, are the following true or false? Explain. A, stocks with the beta of 0 offer an expected rate of return of 0. This is false because beta is 0, but beta times the excess return plus the risk-free rate is the expected return of the stock. So the expected return of return is not zero. It equals the risk-free rate. B, CAPM implies that investors require higher return to hold highly volatile securities. This is false because investors can only get compensation of undiversifiable risk. If the risk is diversifiable, investors will not get compensated. So investors require risk premium only for bearing systematic or undiversifiable or market risk. Total volatility as measured by the standard deviation includes diversifiable risk. So you will not get compensated for firm risk or individual risk. C, you can construct a portfolio with a beta of 0.75 by investing 0.75 of the investment budget in T-bills and the remainder in the market portfolio. This is false because if you want a beta of 7.75, it means the correlation coefficient with the market portfolio should be 0.75. So your portfolio should be invested 75% in the market portfolio because market portfolio has a beta of 1 and 25 in T-bills. The beta of T-bills is equal to 0. Then the beta of your portfolio can be 0.75. Here are data on 2 companies. The T-bill rate is 4% and the market risk premium is 6%. For company 1 is called $1 discount store and company 2 is called everything, $5. What would be the fair return for each company according to the capital asset pricing model, CAPM? So the fair return is the expected return implied by the CAPM. Then the expected return for a given level of systematic risk is given by the formula. This is the expected return on the stock, risk-free rate, and the beta times the excess rate of return of the market portfolio. And what is the return on the market portfolio? It's 4% plus the 6%. So this is the risk premium of the market portfolio, which is 6%. And the beta for this 2 firm, one is 1.5 and one is 1.0. The risk-free rate is 4%. So if we plug those numbers into the CAPM equation, we'll get the expected return of the first firm is 13%, and for the other firm, the expected return is 10%. Number 5, characterize each company in the previous problem as underpriced, overpriced, or properly priced. So if it's underpriced, it means that the CAPM return is lower than the forecast forecasted return. And if it's overpriced, the CAPM return is higher than the forecasted return. So according to CAPM, for the first firm, it requires a return of 13% based on its systematic risk beta of 1.5. However, the forecasted return is only 12%. So the CAPM return is higher than the forecasted return. So the security is currently overpriced. As for the second firm, it only requires 10% with the beta of 1.0. And the forecasted return is 11%. So CAPM return now is lower than the forecasted return. As a result, the security is currently underpriced or undervalued. Safety problems. Number 3, the security market line depicts A, security's expected return as a function of its systematic risk. This is true. B, the market portfolio as the optimal portfolio of risky securities. It has nothing to do with the SML. C, the relationship between a security's return and a return on an index. This is false. The complete portfolio as a combination of the market portfolio and the risk-free asset. This is false. So for the security market line, the y-axis is the expected return, while the x-axis is its systematic risk, or the market risk, or the risk of the market portfolio. Capital asset pricing theory asserts that portfolio returns are best explained by A, economic factors. No. B, specific risk. No. C, systematic risk, which is what you get compensated for in CAPM. So the correct answer is C, the diversification. If you don't diversify, you will not get compensated by the individual risk that you fail to diversify. So the portfolio returns are best explained by the systematic risk. For question 8, first we read this table. It shows the risk and return measures for 2 portfolios. Portfolio 1, it's called R. It has average annual rate of return of 11%, standard deviation 10%, and beta of 0.5. For the market portfolio, the average rate of return is 14% and standard deviation 12%, with a beta of 1. Always keep in mind that the market portfolio has a beta of 1. So when plotting portfolio R on the preceding table relative to SML, portfolio R lies on the SML, below the SML, above the SML, or insufficient data given. The correct answer is D. There's insufficient data because we only know the market portfolio and this specific portfolio. We don't know the treasury bill rate. So we cannot decide from CAPM what is the expected return on this portfolio. So first we need to know the risk-free rate. Number 12, Karen K, a portfolio manager at Collins Asset Management, is using the capital asset pricing model for making recommendations to her clients. Her research department has developed the information shown in the following exhibit. For stock X, there is forecast return, standard deviation, and beta. For stock Y, also with these data, and the market portfolio forecast return 14%, standard deviation 15%, with the beta of 1, and the treasury bill rate, which is very important, is given here as 5%. So question A, calculate expected return on alpha for each stock. This is quite simple. We can just plug those numbers into the CAPM equation. Risk-free rate, beta of stock X, risk premium of the market portfolio, and it will give us the expected return. And the difference between forecasted return and the return implied by CAPM is the alpha, which is the intercept in the regression, in the CAPM regression. For stock X, there is a positive alpha of 1.8, and for stock Y, there is a negative alpha of 1.5%. So if we want to add this stock to a well-diversified equity portfolio, which stock should we add? Well, if we want a well-diversified equity portfolio, we choose the lower beta, because if the beta is high, there is no benefit from diversification. And the other reason is that stock X has a positive alpha. In this case, we will get a higher expected return for the whole portfolio. Number 2, if we want to hold the stock as a single stock portfolio, which stock should we choose? Well, if we just need one stock, we will choose stock with higher Sharpe ratios or higher risk-adjusted return. For stock X, the Sharpe ratio is 0.25, and for stock Y, the Sharpe ratio is 0.48. And for the market index, we can see that the market index has an even higher Sharpe ratio of 0.6. So if we want a single stock, we will choose stock Y. Why is that? Because stock Y has a higher expected return, and it has a lower standard deviation. So the Sharpe ratio the forecasted return, the forecasted excess return over the standard deviation is the Sharpe ratio, and it indeed has a higher Sharpe ratio than stock X. If we use the forecasted return as its forecasted performance. So stock Y is a superior alternative. If we want to hold a stock as a single portfolio, standard deviation, which is the individual risk, is what we want to look at. We don't use beta because in this portfolio there is only one stock. Although holding a single asset is not typically recommended investment, some investors may hold what is essentially a single asset portfolio when they hold the stock of their employer company. Well, you can think that this is some optimism, or this is a reinvestment, or you can think of it as a plowback. For such investors, the relevance of standard deviation versus beta is an important issue because they just want higher risk adjusted return for this single stock. So we just calculate the Sharpe ratio. Although it's not a good hedge against unemployment when the market is really bad, you know, the employees at Google always purchase Google stocks because they just want to share the growth of their own company. But like in 2001, well, Google may not be a good example, maybe for Tesla. If the tech bubble bursts, they will get unemployed and the stocks they hold will devalue. So holding a single stock, especially holding the stock of your own company you work for, is not a very good hedge against unemployment if the economy or if the market is really bad. That's all for chapter 6 and chapter 9. And if you have any questions, feel free to write me emails. See you next time. Thank you.